The equity markets is $100 trillion. The credit markets are $300 trillion. People think that traditional finance is entering Bitcoin, but Bitcoin is entering traditional finance. Gold is a 20 to 30 trillion asset class. And so that's the potential of Bitcoin as digital capital. This is 1 trillion compared with 1 quadrillion of assets. It's 0.1%. Imagine if it's 10% of that 300 trillion, that's 30 trillion. That's literally the way towards market capitalization of gold, literally.
Hello everyone, welcome to the Bitcoin-Treasuries.net podcast. I'm your host Miller Cole, and today I'm joined by Alexandre Laizet of Capital B, Director of Bitcoin Strategy of Europe's first and one of their biggest treasury companies, currently holding, as of yesterday, 3,140 Bitcoin. Alexandra, thank you for coming on to the show and having this chat with me. I guess to start, could you possibly give us a quick intro for anyone not, familiar with the company?
Yeah, thank you, Miller, and very pleased to be with you today. So I am Alexandre Laizet, Board Director of Bitcoin Strategy at Capital B. Capital B has been the first publicly listed company in Europe to adopt Bitcoin Treasury company strategy focused on maximizing the number of Bitcoin per share over time. Specifically, we are focused on deploying the strategy playbook at European scale. And the strategy playbook evolves as well, and we have our own strategy, of course, and we've been characterized by a very institutional, a very transparent, and a very systematic approach to for every operation that we've done to be focused on accumulating more Bitcoin and on increasing the number of Bitcoin per share at each single step of the way. And we believe in the pure play model. We see this as a very much differentiated approach, and we believe we have very strong properties and characteristics that gives us a great opportunity to lead that role and that strategy in Europe. And there are many different reasons for that we can get into, but one of the main aspects is that we are a team of capital markets experts, and we've accumulated 70 plus years of experience in the domain, in banking, in technology, and we are Bitcoin maximalists, importantly. But that is not necessarily enough in capital markets. You also need to understand deeply capital markets, institutional investors, and as well to have the ethics and the forward vision of a Bitcoin maximalist. And those two together can form a really great outcomes. And we've gone from 40 Bitcoin on the balance sheet to 2,000 Bitcoin last year at the same time to 3,000 Bitcoin now, which is quite an increase of Bitcoin on the balance sheet, which is actually comparable in terms of growth on the balance sheet as a strategy and in the middle of a bear market. And so that's for a quick summary. And also our backers are quite special. We have Adam Back, the largest individual owner of the company on the capital stack, together with Blockstream Capital Partners, with TOBAM, with UTXO Management, and 50 plus institutions, together with 30,000 individual investors. And that makes for the most institutional, most liquid, and overall the first Bitcoin treasury company in Europe.
Yeah, so thank you for that overlook, Alexandra. And what I was going to start with is sort of an important point you touched on there surrounding that blend between the Bitcoin maximalism, but also real capital markets experience. And you touched on the background there of some of your backers. Obviously, Adam Back, we all know. Yves Chafetti from TOBAM, who's been in Bitcoin since 2013, built the first fund in 2017, etc. How does that background of those backers you just mentioned affect the first principles approach of Capital B in terms of how you view capital markets in that blend with Bitcoin. You gave quite a good overview there. I guess could you maybe extend a bit on how their influence affects the company direction, or at least the way you think about capital markets at the moment?
Well, we are extremely aligned on core principles that form the backbone of the long-term thesis for why we are doing this and how we are doing this, and every single detail that we choose along that path. And that starts with the very strong conviction on Bitcoin, the strongest one, of course, on Bitcoin, the 21 million. And we are Bitcoin maximalists. We work for Bitcoin adoption. And that's the core, of course, backbone of the strategy. And so since day one, we knew that this was going to be a long-term road, a long-term journey, and that there would be bull markets, bear markets, and that we would expect that exactly to happen. And so where we are right now in terms of traditional bear market, we are not surprised. We literally planned for it. And one example of taking that into account is to have a minimum of 5 years in all the convertible notes that we have issued. Another example is to have issued all of those convertible notes on a Bitcoin standard by being Bitcoin-denominated. And those are two examples, but I could go through hundreds of examples. Another example, of course, is when we designed some of the share subscription rights, so warrants, in the context of certain issuances with institutions and with specific investors, we have added sometimes a condition of MNAV, MNAV 1.1, for example, specifically in certain warrants. And that was not really expected in traditional capital markets, but we did it. And that's because of our focus to continuously maximize Bitcoin per share over time. Another example is, MNAV 1.1 is difficult to integrate within the traditional capital markets. So let's find a solution that would replicate that from an institutional perspective. Well, that's the acceleration notice when the warrant price is reached by more than 30%, when the price of the share at the time of the deal is MNAV 1.3. So like you can have those types of elements that replicate Bitcoin standard elements in a traditional fiat system, but that will maximize your way into growing the Bitcoin per share over time, whatever the conditions of the market at the time those instruments come to maturity or to exercise. Another example is we have constituted a cash reserve quite long ago, and it was like back in September, Bitcoin operational reserve together with a cash reserve that we had constituted before the start of the bear market. I could go on and on, but that's the point is I'm completely laser focused on one, growing the number of Bitcoin on the balance sheet, but in a way that two will maximize the increase of Bitcoin per share. And sometimes, we have repeated so much that the objective is to maximize BTC yield that people forget that what matters is that this objective is within the context of growing the balance sheet as well. And well, sometimes you can do transactions that could reduce slightly the balance sheet, but increase the prospects of more Bitcoin per share. And that's fine. The point is that's a long-term objective over time. So it can be nuanced, of course, but if you have to have those two objectives in mind. Another element is, for example, we talk about digital credit, but we already are planning for what we could do after a potential launch of digital credit. And in fact, we already did a capital market operation that would maximize the potential capital raising proceeds that could follow the potential issuance of digital credit. That's the raise, that 15 million raise that we did with warrants that could enable proceeds of upwards of 100 million euros. And following if Bitcoin goes up and the share price can exceed those targets, and that could of course be accelerated by the potential of digital credit. And we have a balance sheet with no fiat leverage on the Bitcoin Treasury company strategy to date. We have not done equity lines that can be quite challenging for uh, equity holders, for example. Uh, I could go on, and it's all of those examples is because of one, yes, Bitcoin maximalism, that's the core principle, but two, expertise, experience, um, not only of 1 or 2%, but the whole board and the whole components of the strategic investors. And we've been the only European company to conduct large-scale institutional raises. Uh, those types of examples. And I think that organic growth that we have been doing with the different principled but pragmatic steps that we have taken uh, over time have shown a difference between uh, our growth trajectory and our indicators compared with other companies that had good intentions, but sometimes had some choices that made their path more challenging. So or abandoned. So we are. I think the synthesis is we are long-term oriented. We are focused on institutional grade growth that can be sustained, maximized outperformance from a Bitcoin lens, but that also translates into the fiat capital markets.
Yeah, it's fantastic to hear. I guess like one of the biggest criticisms when we look back to September was that most, well, not most, but some treasury companies, such as the ones we're seeing sell now, had no plans in place, let's say, for a bear market, like you discussed. And we're seeing the effects of that now. People who were, companies who were being somewhat opportunistic, lacked the conviction, lacked the sort of knowledge of capital markets, like you guys at Capital B have, and it sort of exploded for a lot of companies, let's say, in terms of that wider plan. So I think what you're speaking about here is so crucial to the treasury model. And when we talk about how management should look at the model as a whole, is that I think they often lack understanding of that Bitcoin, yes, can be very volatile to the upside, but it can also catch you out and cut 50% in a few months, like we've experienced. So, of course, credit to the team for being ready for that. During the bear market, what we've entering about month 10 now, let's say, of a proper bear market or so. How do you think the sort of bear market has affected what you've been building? And I also just, as a second on that, of what you spoke about, wanted to just ask you, what are the advantages you think having a Bitcoin denominated leverage has compared to, let's say, the fiat leverage you've avoided so far?
Yeah, I think it's more that we've had a lot of confirmation of our anticipations than saying that there was effects. In terms of if I had to mention some effects, I would say it has definitely slowed down a bit execution across the space, but everything needs to be compared on a relative basis. As I mentioned, in a matter of 1 year, we have increased the number of Bitcoin from 2000 BTC to 3140 BTC. I would say that this is quite a significant growth in terms of balance sheet growth over a 1 year period, including a bear market. If you take that same period, 1 year, we have increased Bitcoin per share by 18%. If you compare with what you have in the market in terms of the generation of BTC yield, not in Bitcoin per share, but Bitcoin in-kind yield that some would propose in terms of leveraged plays or option strategies or lending and so on. What's the benchmark? The benchmark is 3 to 5% with risk on the underlying. we are not taking risk on the underlying, and we have generated 18% of BTC yield in terms of Bitcoin per share growth. Oh, so one could say, oh, but I prefer a 2, 3, 4% in-kind BTC yield delivered to me in kind, rather than BTC yield in terms of Bitcoin per share that can be materialized over time in the equity, but that's a potential that's determined by the market and so on. But the point is, if you are oriented towards the long term, that is the strategy that probably is maximizing, and on an observable basis has been maximizing the most the outperformance of Bitcoin returns, with a caveat that's for the companies that are really specialized in it. And that's applicable to any industry. If you go to any industry and you ask who is doing the best products, well, it's done by the company that are specialized in it. It's quite easy to understand. And so that's the same for Bitcoin treasury companies. It is great to have Bitcoin adoption across many different companies, but the companies that are specialized in maximizing Bitcoin per share as their number one corporate objective have statistically more chances to achieve that, because the other ones simply are not even pursuing that objective. And so I think that's the point. And we've seen that even within the bear market, strategy has increased Bitcoin per share. Sometimes it's been higher than what it is now, but it's increasing. And Capital B has been increasing Bitcoin per share, and you could observe that in other leading Bitcoin treasury companies. But it's not more than 10, probably less than 10, but the point is, it's already an industry information, and investors are smart to recognize those companies, and those companies are emerging as the leaders in their specific space. And our goal is to be that leader in Europe, and to be an example of that Bitcoin-based growth, with Fiat expertise, of course, in terms of how to get there, and in Europe. And that's our objective. And when it comes to the Bitcoin-denominated convertible notes, they have been an extremely powerful tool for us to grow in a very fast manner at any point in time. And that's a very differentiated capacity that we have with our specific SPV, with the legal know-how and so on that we have in Luxembourg for this. And we have acquired about half of our BTC that way. And the first big wave of converts that we have issued back in March last year, that we have announced back in March last year, all of that tranche has been converted now. And Bitcoin is lower than when we did it. So, it's working. And why? Because the share price when we started the strategy was about 10 to 15 cents. And now it's about 40 to 50 cents with the bear market. So value has been created, and the Bitcoin per share has increased significantly. And it is continuing to increase in the bear market. I took the example of 1 year ago, but that was August. If we took year to date, like in the depth of the bear market, we have increased Bitcoin per share by 2.1%. Like that's comparable to the rates that I was mentioning with the products in the market that say that they can deliver in-kind yield. And in that case, like we have had an MNAV closer to 1, slightly positive, by the way, but closer to 1. And we have generated BTC yield of 2+% in a semester, in a half year. And so that's quite substantial, actually, in a bear market. And when you look at what we've been able to do in a bull market, that was like 1,000 600+%.
It's official. The Bitcoin Treasury's conference lineup just dropped. Grant Cardone, Adam Back, Eric Weiss, the man who introduced Sailor to Bitcoin in the first place. Plus, the CEOs actually running the Treasury companies and the macro voices calling out where the institutional capital goes next. 10 confirmed speakers, 1 closed-door room, September 28th in New York at 2nd. Save 10% on tickets today by using the code SECOND. Reserve your seat by scanning the QR code on the screen or visit bitcointreasuries.net/conference. We'll see you in New York.
If you look at the sector overall, you see it's extremely robust, actually. Between Strategy, Metaplanet, Strive, Capital B, Smarter Web, UTXO is also coming with an innovative M&A transaction and so on. And Orange BTC, those companies keep stacking, they keep accumulating on a net basis, and they are focused on more Bitcoin per share. And this is the focus. And if Bitcoin wins, our focus is to structure the company so that it can create the potential for a major amplification. And that's because of the long-term view, and that's because of the structuring of the products. And the Bitcoin converts are exactly structured for that. It increases amplification without increasing leverage on a fiat basis. And that opens the way for the potential for fiat leverage as well, of course, as a potential. So all of those tools are made for specialized companies that pursue the increase of Bitcoin per share.
Yeah, fantastic. And you mentioned obviously a lot of those keywords we see around the space, like amplification, Bitcoin per share as our main KPI, etc. And you also mentioned the convertibles. And I saw that you announced yesterday that you've, as you said, cleaned up those Blockstream convertibles finally. And I kind of liked the way you put it on Twitter. You spoke about more sats per share, but more digital credit potential capacity at the end of the day. I think you can see where I'm going to go here. I was just wondering whether you could walk me through how, in your mind and the team's mind, how does, just for people who may not understand, how does clearing those convertibles and getting them sort of eliminated off of the capital structure, how does that clean up the capital structure ready for some sort of preferred digital credit sort of instrument, and how does it increase that potential capacity?
Sure. So when an institutional investor looks at the potential for a company to issue digital credit, the consideration of the potential amount of such an issuance would be calculated based on the BTC that is not attached to existing liabilities. And so let's say that it would look at the equitized BTC or the common equity BTC, let's say, adjusted for any liability that would exist next to the existing BTC. And so after that conversion, we have 3,000, that was already the case, 3,140 BTC. And part of those, we have about 821 BTC that are still linked to convertible notes. And so when you look at the potential for a company to issue digital credit, you would look at the BTC base of that company that is not subject to any liability on the other side. And so you would subtract 3,140 by 820 about BTC, and you would end up with a figure that you would calculate in euro or in dollar or in the currency of your calculation, to calculate what is the notional value in a fiat denominated way that the company could use to issue a Bitcoin-backed credit instrument in a way that could use fiat leverage. And fiat leverage would be calculated or amplification, depending on how you call it, would be calculated based on the equitized BTC part of the balance sheet. And if you apply the percentages of strategy of Strive, you see that this range between the 30 to 60% range. And depending on market conditions, depending on, of course, the company judgment, and depending, importantly, on investors' analysis of credit risk profiles and pricing and so on, you would end up with a figure. Of course, that would be dependent on any company or market context and so on. But in that respect, Capital B has a major advantage is that when you take separately the converts, the 800 about BTC, and you end up with the equity BTC, then you have a figure that is pure because we don't have on the Bitcoin Treasury company side any fiat debt that has financed Bitcoin acquisitions. And so that's a pure potential of potential amplification for the company to use with credit instruments. And that's something that the market can evaluate. What's the value for a company to have that capacity? And actually, if you look at our MNAV, it's been oscillating between 1, 1.1, 1.3, sometimes 1.9. It depends, what the market values like year to date of that potential capacity in certain markets. And so that's why the conversion of a substantial amount of convertible notes can increase in that case by 10, 20 million euros, that potential capacity.
Looking at Bitcoin's chart over the past year, we've seen some clean structural trends. Most of you hodl long-term like I do, but to trade short-term moves, the easiest way is with Kalshi perps. Sometimes I'm sure that next leg in Bitcoin's price is just around the corner, and perps allow me to position for that exact scenario. Kalshi has a CFTC-regulated U.S. exchange that are bringing perpetual futures to American traders for the first time. Perps let you trade Bitcoin's price movements up or down with no fixed expiration dates, unlike typical futures contracts. So I can take my leverage up to 6x without even holding spot, and that can amplify both my potential gains and potential losses. Leverage trading obviously isn't for everybody, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. And as always, make sure you trade responsibly and don't forget to stay orange.
And that's quite substantial. In today's euros, 10 to 20 million euros is in BTC. BTC is currently like sitting at 50 to 60,000 euros, and so that's quite a number of BTC already compared with the balance sheet, and not even counting, of course, the BTC that was already there before the conversion. And so that's BTC that was already on the balance sheet, but that now is liberated from those liabilities, and for that part. But our view is as well that that BTC, even the ones that still have some convertible notes, also have significant value because they are of a 5-year maturity by 2030. And from a Bitcoin maximalist lens, you could assume that quite a number of those ones could have the potential to be converted over time. And so, of course, that's a potential, but that's also the value of having long term maturities.
Yeah, great overview. Thank you for going into a bit of depth with that. I think it's really important to have that sort of explanation there for shareholders, etc., to really understand the motivations of why you're doing things such as retiring these converts. Obviously, I think it's sort of a shared sort of focus at the moment, especially with like strategy, Smarter Web, who I know you speak to quite a lot, Andrew, and everyone. This movement towards cleaning up capital structure, moving towards a sort of debt-free or limited debt balance sheet, which of course we often like cite Strive as like the epitome of why that's such a good thing. In terms of Europe,
just on that point, I would say that's
yeah,
quite different actually. Um, it might seem similar, but it's quite different. We didn't retire the converts. The investors chose to convert the converts. And that's even more beneficial, of course, because you don't have to repay. You benefit from the BTC that's already on your balance sheet with a conversion. And so the debt doesn't have to be repaid in cash or BTC. And so that's a massive value. And notably, the conversion was made when, in that case, when the conversion price is higher than the price of the share at the time of the announcement. And so that's quite a significant proof of confidence, of long-term alignment of the long-term shareholders. And another aspect that I would also say is maintaining options is very valuable. And while, of course, I appreciate the clarity, the value that can be brought by a model that's very simple and a strategy that's very simple, with what you mentioned of Strive, focusing on one preferred and one equity and strategy going along that way. It seems to me that while that can be, of course, very valuable, it is not exclusive of a company maintaining uh, options in terms of financing capacities, and that I think that's important. And I would not want to give the impression that it is necessarily going to be the case in the future for any company in the space, by the way. Not only Capital B, but even as well Strategy and Strive, that those companies will not maintain optionality when it comes to financing and so on. And so while the market obviously values a lot the capacity of a company to have a flagship product that's a digital credit leading product in the industry and so on, which is, of course, a main area of focus for Capital B. The ability to maintain other options and other value creation potential, in my view, is quite important, even for the success of the digital credit product over the long run. And so I think that's just a nuance that I think is important, because not all converts are equal in their properties. Our converts do not imply, for example, shorting, which is quite a big difference, and they don't have put dates at 3 years. They have maturities and no put date at 5 years. So it's all of these slight differences that sometimes make a difference. And I do see also differences in terms of stages of growth for companies. But I would definitely agree that the core focus is the digital credit product, to have that potential going forward, but as well maintaining optionality, and in order to maximize convexity, maximize Bitcoin per share accumulation, can also feed into the success of a successful digital credit product.
Yeah, no, thank you for that nuance there. That is a good point. Apologies for the slip of the tongue.
No.
I think you do make a great point in terms of especially convertibles. So I guess that's the sort of a big focus at the moment, especially in Europe as we're moving towards hopefully a more preferred funding model, similar to what Strategy did. And you make a great point there that there is a clear difference between, say, the convertible notes you had versus, say, Strategies, where obviously the majority, we can assume, of those convertibles are held by arb trading desks, etc., who are shorting the stock, whilst having like a sort of call option embedded in that convertible. So I think you make a fantastic point there overall. And I just
even with this, Strategy benefited very strongly from that convert era. So it's
of course, yeah.
It's a question of steps. It's a question of market conditions and the interest of the company and maximization of shareholder value.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
On the Bitcoin standard at any point in time. And so I think that's just to keep in mind.
Yeah, and you guys obviously did that yesterday because actually it ended up reducing fully diluted shares, didn't it? Those bring those convertibles down. So you actually increased sats per share yesterday. So there is like another idea of like, even in a bear market, you can give your shareholders a level of accretion despite the sort of tough outlook.
Well, yeah, that's another example that I didn't mention at the beginning is not only did we create a cash and Bitcoin operational reserve, we also created a free diluted share reserve.
Yeah, so,
probably you didn't hear about that, but that's in our press releases. And as part of this, we had anticipated a number in terms of the impact of the conversion that resulted to be very conservative, and that was slightly higher than the effective one. And so at the time of conversion, the effective number of shares to be issued were actually lower than the one number that we anticipated. And that reduced the free diluted share count by 1 million shares. About that, So
exactly.
And we have more of this, and so that's of course, we always do our best and so on, but that's one part that we believe is part of the focus on maximizing Bitcoin per share at every step of the way. Is to have a systematic approach to everything we do with those principles.
Yeah, fantastic. I guess like a big... Oh.
Did I lose you for a bit?
No, I'm still here. I think I'm just, funny enough, of all people right now, Tyler's calling me. That's why. There we are. Apologies for that. Okay. So what I was going to say was, obviously what we're sort of like moved into here is discussing the outlook for digital credit, the outlook for preferreds. I mentioned, obviously, at least for me, the most exciting thing about Europe at the moment is this race for digital credit, which I've covered quite a lot. I was just thinking, like, if we take a step back from it all and you assess what's going on with yourselves, other companies, obviously we've got Smarter Web, they got their High Court reduction approved, they've cleared the Smarter Convert. Even in Sweden, you had Bitcoin Treasury Capital launch their first like smaller subscription of a preferred, which was paying like 10%. When we step back, what do you see, at least from your conversations and your, I guess, like, observations, what the appetite is for digital credit in Europe right now?
Yeah, I think it's important to take a step back in terms of the historical significance of what we are doing and why this has such a big potential. This, as Yves Scheffetti reminds many times, this has been anticipated in the past. When you look at the works of Friedrich Hayek, with the denationalization of money or currencies, when he anticipated that there would be different private organizations that would issue their own forms of money, and you would have a competition and so on. And of course, while this is not, we are not talking about money in the Austrian economics sense. When you look at what strategy is doing, and when you look at the prophecy of Finney, when he talks about what would be the future fate of Bitcoin, of not scaling as a medium of exchange and having banks sit on top of Bitcoin, but based on Bitcoin and issue their own currencies, that definitely fits with the vision of Hayek. That fits with the reality of Bitcoin being the best store of value and the best settlement asset. And that fits with the role that a Bitcoin treasury company plays in the digital asset, the digital capital markets ecosystem. And the role it plays is to incorporate Bitcoin within traditional finance. And people think that traditional finance is entering Bitcoin, but Bitcoin is entering traditional finance through different ways, through ETFs, through bank offerings, and through private companies that can issue equity, that can issue Bitcoin-backed equity, digital equity, that can issue Bitcoin-backed credit, digital credit, and in a private way or in a public way. And when it comes to the public way, that's where we see the biggest opportunity, because the equity markets is $100 trillion. The credit markets are $300 trillion. And so it's quite obvious that the credit markets is bigger than the equity markets, and that we've seen already very significant growth in the digital equity space, and that we've seen the early signs of the birth of a new asset class of digital credit that is only starting. And the idea is simple. Bitcoin is money, everything else is credit. That's the view of the Austrian economics lens, the view of the Bitcoin maximalist. But from a fiat lens, from the point of view of 99% of the global economy, which are not Bitcoin maximalists, Bitcoin is capital. Bitcoin is digital capital, akin to real estate in a digital format, but fully scarce, akin to gold in a digital format, but absolutely scarce, and akin in some ways to digital monopolies such as the Magnificent Seven, but in terms of the realm of the store of value. And that's how they see it. And the way that it's traditionally done is that, well, gold is a 20 to 30 trillion asset class. And so that's the potential of Bitcoin as digital capital. And if gold also moves higher and Bitcoin moves higher, this can grow even towards the 100 trillion mark at some point. Like, it's all about the devaluation of fiat currencies at the end of the day. But the point is, the market for credit is 2 to 3x bigger than the market for equity or fiat currency. And so when you take credit markets, including bonds, including hybrid instruments, and even some types of money market-like instruments, this is the bigger market, and this is a fiat-based market. And what that fiat-based market seeks is a return that's denominated in fiat, and the volatility that is evaluated in fiat. And the standard in that market is low volatility and relatively low yield compared with the equity ecosystem. And what digital equity can bring or targets to bring and has brought, but can still be in the very early stages of, is the lowest volatility possible with the highest return possible. And we have seen that in the 2 to 3 months where STRC and SATA were extremely successful. You had at some point less than 2 to 3% volatility with double-digit annualized returns, and that was a product market fit that we had not seen for decades, in fiat markets.
This episode is brought to you by Kalshi, and here's what keeps bringing me back to Kalshi Perps. I don't sell my Bitcoin, ever, but there are weeks where I've got a strong short-term view and no clean way to act on it. That's the gap perps fill. Kalshi is a CFTC-regulated U.S. exchange, and it's the first time Americans can access perps on shore. You take a position on whether the price goes up or down with no fixed expirations. You close when you want, and I can go up to a 6x multiplier, which amplifies both my gains and my losses. So I size small, I set my stop before I open anything. Leverage trading isn't for everyone, so carefully consider your own financial circumstances. Scan my QR code on screen or sign up at kalshi.com/p/Bitcoin Treasuries. Trade responsibly and stay orange.
And so that's why Strategy and Strive are that focused on digital credit, because this is what enables to transform the raw digital commodity, which is Bitcoin, the best store of value, into distributable, refined fiat instrument that can fit within traditional fiat market mandates within the credit markets, and throw a percentage of that $300 trillion of credit markets into Bitcoin, which is a $1 trillion asset today. And so imagine if it's 10% of that 300 trillion, that's 30 trillion. That's literally the way towards the market capitalization of gold, literally. So this will happen through different types of credit instruments, not only perpetual equity, but any type of bit bonds, any type of even government credit to acquire Bitcoin, or credit instruments that could be created by banks, or any credit that banks can provide to Bitcoin holders to acquire more Bitcoin, like all of the credit instruments that can be created to accumulate more Bitcoin. But the point is, if a publicly listed company is able to issue a publicly listed credit instrument, a publicly listed credit instrument is likely to have potentially more potential for scale than private instruments. And so that's why a publicly listed Bitcoin treasury company has the most potential into the tapping into that credit markets, and why digital credit, as we understand it today, perpetual digital credit in a listed format, has the most potential to grow in terms of notional value as a new sector, to diffuse much more buying powder into the Bitcoin ecosystem. And I think that's a very positive development, and that's why this is our focus. And the same as Strategy and Strive and Smarter Web and so on.
Yeah, I think like that goes really well into sort of what I thought we could wrap up as the final question here. And it's sort of more just trying to get your perspective on the future of digital credit. Obviously, you used Hayek's denationalization of money as a really good underpinning for that. And it's something I've just started reading myself to try and get into a bit. We're sort of like seeing with the denationalization of money, and the idea behind it is sort of like this organic emergence, the best capital, the best money, etc. Like you said, that is, in our opinion, Bitcoin. And hopefully we will see that emergence. I've sort of linked that to when I was at the Smarter Web conference a couple months back, as you were too. I remember Matt Cole speaking about sort of like his vision for digital credit, and he sort of saw it as like something which could expand like the ETF industry. Now you see 30 to 40 names competing in the same like small ETF sector, dependent on what they're competing on. And of course, how do they compete? They compete on rates, structures, etc. Do you see like a sort of similar vision in terms of where digital credit goes? Obviously, you'll have the Leviathan like strategy, and of course Strive as another big example. In Europe, yourselves, Smart Web, etc., launching digital credit. But then, do you see like a sort of future where you have a number of like smaller companies also try and compete with you in that sector, or do you think it would be something which like more like concentrates into like the big main companies?
I would say it's a matter of steps. In some way, we are quite advanced already, and in some way, we are very early. In the quite advanced way, you see that STRC is ranked as a top line in the ETFs that provide access to those types of credit instruments as a category. And in other ways, well, you still don't have a significant size European instrument of that type, or even, Metaplanet has been very early, but still the instrument is not fully listed and so on. So in that way, the US is quite advanced already, but in other parts of the world, most of the work needs to be done. And we believe that there is a great pathway towards that. We cannot commit on a launch, or that's for us today a clear focus, digital credit, but it's not done until it's not done, and we have not announced any plans of launch of any sort. So I think so step by step, I think that's there are a lot of work to be done, and at the same time that is also the core focus of the company, and we believe that there is a great pathway. In Europe, there are different ways to achieve that objective, and it is possible. The point is there are different moving parts that need to align, and it can take time, but that is also why we are here, and that's our focus. And I strongly believe that over the next 3 to 5 years, we'll see a lot of innovation in the space, and that the category will be broadened as well, that there will be a variety of different instruments, of different issuers, and different characteristics. Strategy itself has a different preferred shares, and of course that might evolve over time, but you will have different issuers with different products that will provide different value propositions and risk return profiles. And the first step, in my view, is more issuers coming, and the second step is more funds coming in, because a sector is forming, and therefore they can now launch a fund that would include a sufficient number of issuers. For funds, sometimes you need like 6, 8, 10 different issuers before launching a fund. You can manage to find ways around that as well. We have seen those types of possibilities. But what I would say is what we see is a decorrelation between the interests of investors and the interests of institutions in digital credit issuance or participation in issuance versus the Bitcoin price. This is a different subset of investors that looks at the credit profile of the company, that yes, takes into account potential evolutions of Bitcoin over the long term, but this is different from the cohort of investors that is purely equity driven and based on momentum and based on the volatility and the expectations of returns over a short period of time, and so on. This is a different type of investor that has already invested in STRC, in SATA, that has reinvested in many cases observably since the last stress test that has seen already quite a lot of recuperation, a lot of strength. STRC is now back like above 90, and I think that that's quite significant in such a short period of time.
I want to talk about something that comes up in almost every conversation I have with Treasury executives. They get the Bitcoin thesis, they see the macro case, but then they walk into a board meeting and the first question is, who's holding it? Are they regulated? Are they insured? Can we audit this? That's where BitGo comes in. BitGo is an OCC-regulated national trust bank. That means they operate under the same federal oversight as the institutions your board already trusts. Your assets are held in segregated trust accounts, never commingled. They're secured in 100% cold storage with multi-signature architecture. If you're building a case for Bitcoin on your balance sheet, BitGo is the custody partner that turns a board conversation from why into when. Visit bitgo.com/Bitcoin-Treasury to connect with their team.
You wished for it. Bitcoin is finally on sale. And if you're sitting on BTC and want liquidity without dumping your stack, Arch Lending can make it easy. You can get USD or USDC in minutes, and your collateral stays in qualified custody. They never rehypothecate your assets. As your assets move up and down in value, you can scale your credit line instantly or pull collateral back when the market runs. If you need help, you get real humans 24/7, not bots. This is Arch Lending. Simple tiers, public pricing. You can check them out at archlending.com.
And it's quite likely that by 2028, you will have a digital credit sector that will be thriving and that will be in the context. I'm taking the assumption of a bull market that could happen in the same ways as the past. I have no crystal ball, but this is just a potential, of course. But taking that assumption, you could imagine a digital credit sector thriving, growing in the multi-tens of billions of notional value, driving towards the hundreds of billions. That could be for the next cycle again, but or the cycle after, to be more precise, after 2028, like more in the 2030 or so. But if we arrived in the 2030, 32 to 100 billion, 200 billion, 300 billion dollars of notional value, that's like comparable in significance to what is the stablecoin market now. So when you look at that, then you realize that like the stablecoin market in the US is taken very seriously by the government, and it's quite likely that this will be taken very seriously by a lot of different institutions, if not the government, a lot of different institutions that will not only want to pay attention, but will have to pay attention in the same way that when strategy was taking a 3, 5, 7% and sometimes 10% of the convertible note market, the convertible note market participants had to participate, because if not, they took the risk that their competitors would have performance that they would not get. And so they had the obligation to participate, at least in a small way, as a carrier risk insurance, And I think the same will happen with digital credit, and it will coincide with a track record of 3 to 5 years of the industry that will coincide with the track record that strategy had when it started to really scale with the convertible notes. And this is what I think is misunderstood, is we are so small as a Bitcoin ecosystem in the realm of traditional capital markets. This is 1 trillion compared with 1 quadrillion of assets. It's 0.1%. We are so small that any increase of size is not something that will make for a lowering of the growth rate of the industry. Instead, every growth increase, size increase, will increase the pace of growth of the industry, because the more capital goes into that industry, the more it becomes accessible to new investor institutional pools, and the more you have liquidity, the more you have capital coming in. And I think people forget, what was happening in terms of traction when digital credit just started to show its potential a few months ago. And the strong belief is towards the next bull market. The digital credit is likely going towards par again, and when it's towards par again, this creates a major imbalance between offer and demand, and strategy itself, and doubled by Strive and the other potential participants that, of course, we aim to be part of, are likely together to be taking in 2, 3, 5x of the natural offer in the Bitcoin market. And that is illustrated by strategy. We've seen strategy passing BlackRock in terms of Bitcoin balances in total. And that shows the power of digital credit. And strategy has accumulated like 150K plus BTC year to date. This is very significant. And it's not because strategy has sold like a few thousand or so Bitcoin that this changing anything substantially. This is marginal. And I think that all comes down to also Bitcoin growing over time, and that's also a dependence on monetary devaluation over the world. And when you look at monetary devaluation state over the world, you see that this is a race towards more devaluation, and that this is the requirement for all the government's objectives, which include reindustrialization, which include remilitarization, which include reshoring of AI capabilities, and which include a race in AI, which includes creating energy generation capabilities in each region, which are not existing. And this is not going to be achieved by more taxes or reducing pensions or reducing military budgets. On the contrary. And that's going to be achieved by a more monetary devaluation, and by shifting towards a hard money standard composed in the traditional markets of gold and Bitcoin. And our view is that Bitcoin is going to be the faster horse in that race in the next 10 to 20 and infinitely, as it is absolutely scarce compared to the alternatives.
What a way to cap it off. A very exciting vision. The sky's the limit, I guess, for digital credit and the markets it can take on. Well, Alexandre, all I can do firstly is thank you for your time. I'm sure the listeners really appreciated you coming on and having a chat about your sort of outlook for not just Capital B, but the wider European sort of system and the Treasury ecosystem as a whole. So thank you for everyone for listening to the BitcoinTreasuries.net podcast. And Alexandre, thank you again for your time.
Thank you so much. Talk soon.